Make sure to claim your 2 free stocks with Webull. The Iron Condor option strategy is a risk-defined neutral options trading strategy that benefits from premium decay and minor up or down moves in the underlying asset. Essentially, an Iron Condor is a call credit spread combined with a put credit spread that, when executed properly, produces a trade with a net delta of around 0. In the Iron Condor strategy, you will sell one call, buy one call further out of the money short-long call, sell one put, buy one put further out of the money from short put. Iron Condor example. Stock XYZ is trading at $50 a share, so you sell $53 call for 50 cents, buy $55 call for 20 cents, sell $47 put for 60 cents, buy $45 put for 40 cents. By doing this, the trade would create a net credit of 40 cents times 100 equals $40. The credit comes from the combined premium of the call credit spread and put credit spread. The best case scenario for an Iron Condor is for the underlying instrument not to move at all. If stock XYZ stayed at $50 until expiration, this trade would be a full winner. Maximum profit and loss for the Iron Condor option strategy. Maximum profit for an Iron Condor equals premium received. Maximum loss for an Iron Condor equals width of strikes minus premium received. In the previous example, the max profit is $40. The max loss is $360. Max profit will be reached when the Iron Condor expires with stock XYZ trading between the short strikes of the Iron Condor at expiration. Break-even for an Iron Condor. There are 2 break-even points in the Iron Condor option strategy: the upside break-even and the downside break-even. Essentially, these are the same break-even points for a call credit spread and a put credit spread. Downside break-even point equals strike price of short put minus premium received. Upside break-even point equals strike price of short call plus premium received. Why trade Iron Condors? The logic behind employing the Iron Condor option strategy is to capitalize on theta decay while expressing a neutral outlook on an optionable security and avoiding undefined risk. After all, who really knows if a stock or futures contract is going to move up or down? Note, this does not mean Iron Condors are not speculative trades. Iron Condors are indeed highly speculative. By placing an Iron Condor, you're speculating that the underlying instrument will be within the short strikes at expiration. The reason why the Iron Condor option strategy is popular is because large moves in the underlying asset are not needed for the trade to be profitable. If the underlying asset does absolutely nothing before expiration, the trade will be a winner. The underlying can also move up or down within the distance of the short strikes, and the trade will still be profitable. Moreover, the Iron Condor option strategy is risk-defined. This means there's no potential for a disastrous loss that is always possible with uncovered short options positions. Well, that's it for today's video. Don't forget to smash the like button and subscribe to our channel.